Yeah, look, it's a really interesting time in markets. We feel there's a bit of a conundrum at the moment, especially when you look out around that 12-month time frame. So equity markets are clearly sort of the glass half full outlook at the moment. You know, pricing in earnings growth in the US, for example, around 10 to 12% earnings growth for the next 12 months. Bond market, on the other hand, seems to be a lot more pessimistic, probably a glass half empty type of outlook. You know, in the US, for example, pricing in 100 basis points of rate cuts next year, suggesting, you know, a slowing economy will afford the central bank the ability to cut rates. And that's really a dichotomy. You know, you don't normally have that. We have earnings growth is because of a robust growing economy. You wouldn't see rate cuts as if the economy's slowing. So we're kind of really at odds at the moment. I think participants are scratching their head a little bit about the resilience of economic growth. You know, where is this recession we were supposed to have? And I think to explain that, you probably have to go back a step to the pandemic and the huge amount of stimulus that was put into the system, built up really, really large savings buffers for households and businesses as well. And those savings buffers are slowly being eroded. And we see that sort of expiring in the next 6 to 12 months. And so we think that we're really on the cusp possibly of an acceleration in the slowdown. You're starting to see some small cracks come through in the consumption data in the most recent earnings season, both here in Australia and in the US. And you're also seeing some cracks in the employment market as well, where unemployment's just starting to tick up off its lows. So look, we've got a bit of a cautionary tone on that outlook, and we're probably siding a little bit more with the bond market than the equity outlook at the moment. We see an opportunity in avoiding a specific risk, if I might put it that way. The risk we see at the moment really is around the concentration in equity markets. So equity markets this year have had really good returns, especially in the US and concentrated in that tech sector. In fact, if you look at it, the sort of top 7 or 8 stocks really speak for the entire returns of the market. And so what that's led to is a very concentrated market. The market cap of the top 5 stocks, for example, are around 25% of the S&P 500. Now that exceeds the concentration that existed in the sort of 1999-2000 market, where there was a big concentration in those tech stocks as well. But if you look under the hood, it's also valuation extreme as well. So on a EV to sort of sales metric, if you like, we're up at around 10 times next year's sales for those top 5 stocks. And that's getting up to levels we just haven't seen since that tech bubble in 1999-2000. So the risk is that you know, investors that might be in an S&P 500 market weighted ETF, for example, really are taking quite a concentrated bet in that tech sector. And you know, should that unwind for whatever reason, and some of those extreme valuations come back to the market, then that poses, we think, quite a risk. We know that after that bubble burst in 1999-2000, for example, an equal weighted index, so where you weight all your stocks equally rather than by market cap, outperformed the market cap index by about 100% over the next 7 years. So we just want people to be aware of maybe a risk they're taking they don't really appreciate. So over the last 12 months, we do have our equity weights in the lower end of our range for those reasons that I just spoke about. We're a little bit concerned around, you know, this sort of excessive optimism that's been priced into markets. Really, the returns that have come from the market year to date have come from multiple expansion, so not through earnings growth, but rather through a higher price to earnings multiple. And we're real cognizant of that, so we've downweighted our equities to a lower end of our equity range. We're carrying a reasonable amount of cash. We like the optionality that cash provides. We think that this long-awaited recession, should it come, will provide some really interesting opportunities to deploy capital into. The other bucket that we're really maximising at the moment is what we call our Diversifiers bucket. So at Atrium, we focus on a risk-targeted approach, and a big part of that is allocating to diversifiers or liquid alternative strategies, because we think a strategy that can deliver absolute returns regardless of the direction of the equity market or the bond market, for example, could be especially valuable in the coming 12 to 18 months. I guess a tactical tilt would be probably that higher than average cash weighting, tilted to, you know, taking advantage of short-term dislocations in the market should they come along. The other thing we've done is we have started to add some duration or some government bond exposure to our multi-asset portfolios. For a long time in the prior decade, we had no government bond exposure. We didn't like the risk reward when the yields on 10-year government bonds were down around 1.5%. But with government bonds in Australia and in the US having sort of a 4 or 5% handle at the front, 4 or 5% yields, we start to like that as a part of our multi-asset portfolio. So we are tilting a little bit towards duration. The last one we have at the moment is a position that stands to benefit should the Chinese currency continue to devalue. So a big risk out there at the moment that people are focused on is the risk of the Chinese economy struggling with its property sector and other parts of the economy. So we have some protection there that will benefit should there be further devaluation in the Chinese currency.